Hello, everyone, and welcome to another episode of the Eitel Insights podcast. My name is Dane Eitel, and I am the founder and lead analyst for Eitel Insights. Today, we're going to be going over the Greater Vancouver detached housing market update, and as you can tell by our title today, the divergent trends dominate the Vancouver housing market. Now, before we do get into those divergent trends and all of the technical analysis, analytical interpretation, offering you actionable intelligence, we're going to go through our usual preamble. So we are inching closer to surpassing 600 subscribers, of course, with your help. If you feel free to share this with your friends, your family, and your social media platforms, we'll be able to surpass that. And one other thing, give us that thumbs up. It means a lot for us. It helps the algorithms. It helps us with our viewership. And of course, we're always looking to get more subscribers. So if you don't mind doing that, it's one click for you. It goes a long way with us, and we'd greatly appreciate it. That being said, we're going to get right into the charts. I'm going to show you on the full screen, then I'm just going to move it over here on the side so that we can continue the conversation. So October finished the month with an average sale price of $1,714,902. Now, that's basically $1,715,000. That's what we're going to call it for the rest of the podcast. That is basically a $4,000 movement or a $5,000 movement higher than last month. So it's seeming like this market might be hitting its head. And why is it hitting its head? Why does it seem like it's topping out? Well, you can get a lot of fundamental reason, and they'll have their guesses. The technical analysis that we've offered have not steered you wrong. We're getting into that. But crucially, what's going on right now is the data is testing that orange line, which is the downtrend instigated at the market peak during 2017 at 1.830. So anybody that says market peak conditions are in are not correct on the overall greater market average data price. 1,830,000 was in May of 2017, and currently we're at 1,715,000. Where's the higher? It's not higher. It's actually a lower high, which is exactly what an ABCD trend looks like. So we're going from highest highs to lower highs and lower lows, ultimately resulting in a market cycle. Exactly what we said in our original publication during October of 2017. Ironically, at that time, we did call for 2021 to be the market bottom. The years that have followed 2017 and preceded us currently have given us a lot of belief into why we're correct. Now, what's gone on to get us to this data point? Well, originally, again, market peaked in 2017, but 2016 was a very clear or very close market peak. The first 6 months were an average sale price of $1,784,000. The actual topping out came around in February at $1,820,000. I'm going to tell you why that first 6 months was so important as to what is going to occur here in 2021 in a bit. But before we get to where we're going, let's remember where we have been. So again, on this chart, you notice that there was a precipitous fall from 2018 to 2019. In November of 2018, average sale price was roughly where we are at right now, $1,710,000. After 4 months later, the average sale price was $1,468,000 in February 2019. Now you see that was a significant market drop. Now why is that? Well, it's because a number of reasons. The market data had come back into that upward channel, the two black lines going higher. And it originally, after it broke out of the top line, eventually came back into the top line and showed that it was no longer worthy to even be testing that top line of the growth cycle. So ultimately, prices went lower by $237,000 lower between November of 2018 and February of 2019. Now, why did the market bottom there? It's because it hit this line. Not only did it hit the uptrend that we've placed there for a number of years, but also because it intersected with the lower echelon of the market cycle, which are those orange horizontal lines. So, I mean, from the beginning till likely the end, Eitel Insights will have correctly analyzed this market. Now, the bulls that are saying the market bottom was in 2019 never called the top in 2016 or 2017, or 2018 for that matter. They said it's going to continue to get better. And now those bulls are actually concerned, like, oh my gosh, that should be a challenge, right? So with this new highs, even though they're not highs, they are lower highs, this seemingly is roughly the end of this period of strength. Now, how did we get a period of strength during a pandemic, right? Well, as we said in the past, nobody goes broke fast. So people stop spending so much, stop going out for dinner so often, and decreased maybe their car value. Instead of driving a BMW, they might have got a Volkswagen, something to that effect, right? And that's what we had noticed during 2018 and 2019. To say that our current circumstances are any better, I would absolutely take the other side of that argument. So the CERB mixed with other stimuluses since February boosted or put in $56 billion of stimulus. Do you know what the actual losses were during that period of time for for COVID-related loss of wages? It was only $23 billion. That leaves you with a net of $33 billion of stimulus pumped into this market. That's one of the reasons why you did see this impetus or influx or exodus from the condo market to an influx of the detached properties. First of all, people are working from home, and there could be teaching from home. So if you had a young family living in a condo, you really needed that detached properties. And subsequently, what we saw, now I'm going to shout out a comment on the last podcast. It was a Joseph Lim, and he said there's a K-shaped recovery going on. That's absolutely true. It's maybe not the exact K-shape as what you're known to economists. What K-shape in the economy or on Main Street means that the high earners, the high wage families are impacted, but not nearly as much because they can borrow cheap money, which puts them into a better position. If you're just a middle-class family or a person trying to get along in this world, you're impacted, but you can't borrow money on the cheap, even though interest rates are low. There's nothing for you to borrow, so it's a challenging period of time, right? And that's what the K-shape on an economy looks like. A K-shape in the real estate market, which is what I believe he's referring to, is the high-end markets are just getting crushed while the entry-level markets have risen. Now, the entry-level markets are creating new highs by about $1,000 or $2,000 here or there, while these high wage value areas are down 20, 24, or 30%. So significant losses in the high-end market. Again, so your entry level got that bid. It got a lot of sales based on that pent-up demand, but more so the pulled forward demand. So owner or potential purchasers during 2021 said, not waiting, gotta buy now. Can't buy in Burnaby, can't buy in New West, let's go to Maple Ridge, let's go to Port Coquitlam. Those areas are getting their bids. Ironically enough, the high-end markets are very close, or closer, much closer than they have been given historical precedents to these entry-level markets. So if you're looking for an investment, which is what Eitel Insights offers analysis on, is an investment mindset for buying and selling. Now, there's nothing wrong with being an owner-occupied property and still having an investment mindset. We're going to get into a few examples of that here shortly. But no, we don't buy during market peaks when it's a frenzied market mentality, because eventually there will be a drop-off. Unless you believe that this market is strong and will continue to grow stronger. Again, I would take the other side of that argument. So let's get into, let's go through a couple of examples from 2016 to now. So again, the bullish mentality or bullish theory of investment for real estate is to buy and you're going to be fine. Okay, and every 7 years or 10 years, real estate doubles. Okay, on average, you're right. However, this isn't average times, nor is it ever average times. You should be advising your clients on a better entry point and a better exit point, depending on what their impetus is for buying or selling. So let's just go through a couple of examples. Remember 2016, everybody said the market's never going to stop. It's just running rampant. Well, okay. So 2016, a purchase occurred in February 2016 at $6,350,000. They just sold in October for $5,900,000. Well, that's a $450,000 loss, basically after a 5-year investment, or 4 years and 8 months. Call it 5 years. That's not how Eitel Insights clients invest, right? We'll find a market that is maybe low in its cycle, and we can take advantage of that. But we don't buy high in market cycles. Let's give you another example. Now, this one was a tear-down property, according to the buyer. It was purchased again in February 2016 at $9.5 million to tear it down. They tore it down. They went to the city hall, got some permits, and had some ideas, and it's all drawn out. The only unfortunate thing is the market didn't continue to go higher when Eitel Insights way and went much lower, significantly lower. Sale price just occurred at $7 million. Now, that's a $2.5 million loss on a property you didn't even have the advantage of living in. Like, you didn't even pay your own rent. It was a speculative deal that just lost you $2.5 million. That doesn't occur to Eitel Insights clients, okay? Now, I hear you. You're saying, the bulls are saying, well, that's only a 5-year investment. That doesn't count. Okay, let's go to a 12-year investment. 12 years. 2008, the property was purchased for $8.1 million. 12 years later, just sold for $6.9 million. That's a loss of $1.1 million on a 12-year investment. Now, of course, that's not your average, but here is a live example, like a live living example that just occurred. So what actually happened, and I pulled up their individual market charts, during August of during August of that year, the market had actually seen a spike up. So they purchased during peak market conditions, which actually fell off, as we know, during 2009, right? So when you buy at an exorbitantly high period of time and market psychology is just running rampant, running frenzied, there's probably not too much room for that value to increase. So purchased at a very high period of time, missed the next market cycle, and actually we're into a third market cycle since that purchase, but you're selling at the low end of that in particular market cycle, which is actually very close to that anomalous high point of data during a previous period of time. So that's why they actually lost $1.1 million. If you had bought anywhere along the way, even in the next market cycle, 2 or 3 years later, during that market low, this person would have done quite a bit better. And I mean significantly better in the result of a sale price. Not to mention maybe we wouldn't have advised to sell during this period of weakness during that market cycle. And let's just leave you with one more. Here's an 8-year investment. Purchased at 5.65 during 2012. Again, it was actually another market peak during that individual time. And now he's sold on a market low. It's unfortunate, but advice, that the action or the analytical interpretation that we offers real actionable intelligence. If they could have held on to this property, it would have done much better years later or years earlier. So again, 2012 purchased for $5.65 million. 8 years later, just sold for $5.9. Now this one gained $250,000 after 8 years, right? That's not investment theory. You put $5 million into any investment and you got $250,000 back after 8 years, you might fire that broker, especially if it's a market. So this is the kind of actionable intelligence that Eitel Insights offer. Now, how do we get to going lower from where we are right now? I did mention 2016 was a very crucial time. Why that was so important, the first 6 months of the year, again, average sale price of $1,784,000. During that period of time, there was 11,400 sales. Okay, those mortgages will be up for renewal in the first 6 months of 2021. Given current prices at $1,715,000, they're underwater $70,000. It's going to be a challenging time. If anybody lost the job or there's a change in circumstances, we will see mortgage deferrals that are obviously coming and will ultimately end, which will lead to mortgage in arrears, which of course leads to foreclosures, foreclosure proceedings, which before that you'll have an impetus to sell, maybe a need to sell. Something that we've described for the last year, 6 months or so would be occurring. And again, during that initial market peak, prices have fallen off roughly $360,000 from that peak to the near-term bottom. We're not, the future bottom is going to be lower than the near term. The near term was roughly, let's call it 1.5, even though it was 1.468. Let's call it 1.5. That's where the average number of the 6 months data really was concentrated at. We ultimately believe this market goes down to 1.4. Now that will be a total correction of 23%. You're going, that's a lot, and I hear you. Now we don't usually get into the fundamentals, but I'm going to get into the fundamentals here very quickly. Let's take what's just transpired here in BC with our local governments. It's not a change in government, but it actually is a change in government. Okay, so the last 3.5 years were governed by the NDP, but it was actually a coalition government with the Greens. The NDPs weren't actually elected by a majority basis. Actually, the Liberals got the most amount of votes per region, but with the combination, the coalition of the NDP and the Greens, that resulted in our government. Now, not only are the NDPs actually elected, they seemingly have a mandate, right? And maybe take the man at his words, where he says we're going to make housing more affordable. Now, it's great for buyers. It's a challenge for sellers. 3.5 years have proven that prices are down from 1.830 to 1.715, right? That's $115,000 lower. Where they have been are obviously lower than now. That's where we believe they're going again. He's got 4 years to do exactly what they have said they would do. And not to mention the market's own volition is inside of a market cycle, and it seems to be creating lower lows mixed with lower highs. And that's what we do anticipate for 2021. So if you got 11,400 properties that are in a challenged position, you're going to see a large percent of them come to market. And if they can't achieve a sale based on all these, you'll hear the highest sales in October. It's correct, but only based on other Octobers, based on other seasonal high watermarks, which this year clearly isn't seasonal. And we're going to get to the sales, you'll see. It's nowhere near high watermarks. It's just not. So to think that all of this pent-up demand and pulled forward demand will continue to last, we think is erroneous. We think that this was your upshot of a market during a pandemic, forced people that were thinking about to buying a detached into actually buying a detached. Clearly, they didn't go to all markets. They went to the entry-level markets. That's going to be a softening of your demand going into 2021. Based on current levels, add in 11,400 properties, not all again, but a healthy percentage, it won't take much for this inventory to increase, right? And that will completely change the supply-demand dynamics. Now, here's a bit of actionable intelligence for you. We forecasted what we believe the prices will be in 2021 based on where they have been in 2016. So you got a 5-year investment thesis. That's what we're working with here. So if you purchased in 2016, there will be 9 areas across the 20 that will have not increased, but not decreased very much. You're going to be at a very much of a similar level from the 2016 average sale price that you purchased at. If you go to sell in 2021, you're not going to gain much. You might not lose much, maybe commissions here and there. There will be 8 markets which are significantly less, much lower than the purchase price during 2016. So those areas will be a great challenge for the homeowner to sell. Now there will be 3 markets that are higher than 2016. They won't last higher very much longer going into 2022. They are the market laggers. So the markets that are creating highs right now, the 3, you might want to avoid them from an investment level thesis. We like buying low and selling high, not buying high, waiting for the low to occur, and then waiting for the next high to occur. That just adds time to your investment thesis, like what we've seen with this 12-year and the 8-year investment mentality. It just doesn't work, right? So again, we picked the bottom, or the near-term bottom during 2019 at 1.5 based on the technical analysis. The data came down and tested our lines. It didn't have any fundamental reason to change. No, it's the technical movement. It's the market psychology that technical lines actually showcase. That's what they're saying. Here are the trends. Here's where a long-term trend of psychology will say buying will occur. And here's maybe where selling will occur once again. That's where we believe we're at now. We believe selling will begin to occur, which will lead to lower sale prices and more competition amongst sellers and less competition amongst buyers, which should be good news for the buyers. Now, I did mention the sales chart. I'm just going to go over that here quickly. I'm going to share it on your screen. So the sales in October were undeniably higher or than the sales channel you see on the chart there over the preceding majority of months. The last 4 months have broken out of that sales channel. Now, we didn't believe the sales channel would be broken out of this long. Clearly, it has. Data shows up. What's important about that is it did break out of that downtrend line. Once you break out of the downtrend line, the orange line's there, you do see a volatile reaction. Now, we'll see what happens here in the first quarter and second quarter of 2021 and see if the data comes back inside of that sales channel, which is what I believe will occur. And this is just a new higher high that will be coupled with going back to seasonal averages. But let's just go with the seasonal averages. October, everybody, once again, the highest sales of October. That's awesome. October aren't your usual seasonal high sales months for the year. Take a look at the data, go right across. That looks like an average market. Literally, that's smack dab middle of the chart. So when you're so bullish or so confident about these sales numbers that are just like an extreme highs, you guys are saying these are extreme highs. Well, all it is average. So if these are the extreme highs that are average, chances are we're going to go into a period of weakness. And that's what we do believe will occur. I'm going to wrap it up here rather shortly. I'm just going to show you the inventory levels. We're going to pop that on your screen here. So the inventory did pull back for the first time in 7 months and left us with 4,454 active listings. Again, it's perfectly testing our uptrend. We don't move the uptrends to try and coalesce to the data. We leave our data lines, and the data points eventually come and test our lines. We don't move our lines. The data moves for us. Okay. We could test this horizontal black line, which would likely be the low, and I believe that was right around 4,200 active detached properties, if I'm not mistaken, maybe 41, somewhere around there. But again, this will change due to the amount of inventory coming next year, coupled with the lack of demand based on the demand already being expelled here during 2021. The new inventory, the actual new inventory that came to the market in October did decrease again from September. September was 2,042 active brand new properties. In October, there was 1,755 brand new active properties. That is average again, and given our seasonal the unusual seasonal activity, I mean, eventually it will end. Going into 2021 again, seemingly like we have some handle over this COVID, or at least just the new normal. So we know how to adjust ourselves and live our day-to-day lives with this COVID. We will see probably a more return to a normal market in 2021, especially for the sellers. Maybe not so much for the buyers, because the buyers will finally be in control. You'll be hearing about foreclosures. You'll be hearing about properties that lost after a 5-year investment. You'll be hearing about mortgage renewals not going so well because you didn't have the income in your property is significantly down in value. If you did purchase in 2016, you're thinking about a sale in 2021, either out of a need base or out of a want or out of a desire, you might want to get in touch with Eitel Insights. We'll tell you exactly where you are in your market cycle and what that is projected to look like going forward. That's what we do right across Canada. Now, there were some questions, do we do Victoria? We absolutely do Victoria. We'll do Winnipeg. We do Toronto. We do Halifax. We do Kelowna. We can do the smaller areas, but of course, this is our main feature. Vancouver is our flagship market. But yes, if you want to become an Eitel Insights member, by all means, visit eitelinsights.com. You can send me a personal email. If you have any questions or comments, please feel free to leave those in the comment section. Hopefully you enjoyed our content today, and that will spur you on to share our message. If you are so inclined, again, please feel free to share it with your friends and your family, and give us that thumbs up. It means a lot. We appreciate you listening today. Take care, folks. We'll talk to you soon.